Who's really in charge when you borrow money from a bank? You fill out the application, you wait for the approval, and you hope they say yes. And when they do, every dollar of interest walks out your door and into someone else's pocket. There is another way, and once you see it, you can't unsee it. Last week, we talked to you about the annual reset and locking in your wins. This week, we're talking policy loans versus bank loans, life insurance cash value policy loans. This is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
All right, simply put, a bank loan, you have to try to qualify for it. They get to decide whether to approve you, and you pay them back with interest. A policy loan, you get to decide, no one has to approve it, and the interest comes back to you. Well, to the insurance company, but it doesn't stop the growth of your interest inside of your account. Policy loan versus bank loan. Where do you see things, Carlo?
Well, I think that there's places for both of these things, but the thing that I would advocate for, and I think we would advocate for, is having both of these options in the toolkit. So it's not like, for example, on my house, I have a mortgage. It's through a bank. It makes sense. The rate is phenomenal. I didn't have the cash value, or I didn't have life insurance when I bought this particular house, but that is the situation where I will continue to maintain that mortgage because I have a really good rate and it's a good scenario now that I have it approved and I'm making those mortgage payments. So there's a good place for it. But at the same time, having that line of credit that I have with the policy loans that I can get for my life insurance is a great tool depending on the scenario that I'm trying to work with.
So there's a time and a place for each one, potentially. Let's start with the bank side. When it comes to a bank loan, what are the reasons people don't really like to go get bank loans?
Well, I think one of the big things is they're going to pull your credit, they're going to ask you your life story, and you're going to have to give all of this information over to justify why and how you can pay that money back. And that process it's not the most clean or simple process, especially for those who are, not coming from doing lots of these types of loans. So it is a bit of a process to get those types of loans.
And let's also say that a lot of times when people are going to the bank for money, it's because they need it. They really need it. And when you need it the most, that's when they don't want to give it to you. What happened in 2008 when the market was crashing and real estate prices are coming down and people needed access to cash to go do investments or just to meet their bills because maybe they lost their job? What happened with all the loans available out there? What happened when people would go to a bank to try to get money?
Yeah, I think it was very common in 2008, 2009 timeframe for banks, even if you had, let's say you had an approved home equity line of credit and it was open already, there were many of these lines of credits that were just closed, even though you had maybe 100,000, 200,000 in that line that you could have drawn. They actually shut down many of those lines of credit. And it's not just the HELOCs that were subject to that. It was various types of lines of credit. And if there were callable loans, like there were banks that were calling loans. And so that is a risk. It's not a lot of the protections that are in place now make it such that most of your normal loans are not going to just be callable in an instant. But it was a thing, and there are still circumstances where that can happen as well.
So let's just say that it may not be a reliable source of income or a reliable source of funds when you really need it. You might not be able to go get a loan from a bank when it's needed.
Yeah, I think that's exactly the case. And I think you said it really well. Initially, the people who need the money most are exactly the scenario that underwriting process catches and says, no, don't give them that money.
Yeah, so now let's shift over. You got people who are good borrowers. High credit. Credit's not really a concern. Even if you have multiple inquiries, we're still up in the high 700s, 800s for a credit score. We don't really worry too much about that. But there's still the hassle of having to jump through the hoops. I know as a business owner, as a self-employed person, that it can be complicated to get all the paperwork required to prove all of my business income. And they'll always want to see tax returns, a couple of years of tax returns, among other things.
Yeah, I think even so on my side, most of my income is from good W-2 income. And even that, it still is a process. And I think so whether or not you're a business owner or even W-2, there's a process. And I don't like my bank actually called me because they were like, oh, well, we got all these lines of credit. So I get calls, I think as a person who has good credit, good situation for the most part, I get calls offers for giving me money, but I don't want to jump through all of those hoops to get those loans unless I absolutely need to, because it is more of a process than I prefer.
Yeah, so even for those of us who have good credit, good income, and we're really pretty confident that we're going to be able to get the loans, there's always that little bit of hesitation, the little bit of questioning in your mind that says, are they going to approve me this time or not? Maybe something else pops up that's new and they're going to say no this time. You just don't know. Let's contrast that with getting a policy loan. You've built up cash value in your life insurance. I've built up cash value in my life insurance. We have access to it. It's a line of credit, just like any other line of credit. But what do we have to do to get it?
In my case, it's as simple as filling out some forms, and it's easier in one of my policies to have an online portal to submit that loan form, which basically I put my policy number and the loan amount that I want, couple of like a signature here or there, and it's really very simple. And I have yet to have a situation where I've submitted that and it took more than 7 days for those funds to clear. I think that's about the top of how long it's taken. So really simple process to get access to those funds.
Now, some of my life insurance, it's just a couple of clicks on their website and the money's in my account in a couple of days. That's best case scenario. Not every carrier is at that point yet, but I do anticipate all carriers moving into the 21st century technologically in the near future. And so it should be available with a few clicks of a button on all the carriers' websites, probably within the next decade. And we're going to own these policies for many, many decades. So I'm not too concerned at whether it's a click or a form. But when you said you just have to fill out some forms, it brings back nightmares about buying a car or buying a house where you've got a stack of forms that you have to fill out. So enlighten us a little bit. How many pages are these forms that you have to fill out?
I mean, really, it's like three fields of things that you basically put the amount, what you so in the case of like let's say my IUL, you want to specify the type that it's going to be, and then to whether or not you're going to use the indexed or the wash loan, and really that's the majority of what you're filling out, and your policy number, your name. So it's not like your normal loan process with a bank. It is a very, very basic form that is, for the most part, you don't have to fill out most of it. And really, if you just get in touch with one of us or your agent, you can get guidance on how to fill out the form. It is pretty simple. So it is definitely not like your normal nightmarish loan scenario.
So you said a couple of fields that you have to fill out, or a few fields, but the answer I was looking for was 1 or 2 pages. And
Yeah.
it's not even a full 1 or 2 pages. It's just a couple of parts of 1 or 2 pages.
Yeah, exactly. And that's what I'm saying. It's like you're not filling out all of 2 pages. It's bits of a couple of pages, basically.
And then when you put that request in, what has to happen on the insurance company side?
They just basically have to assess, do you have the cash value to support this? And there's going to be like a little bit of a buffer depending on how their policy it operates. But really, if you have the cash value in there, they're going to distribute those funds.
Yeah, it happens very quickly. And as long as I've been doing this, I've never seen a delay. However, insurance companies do reserve the ability to wait up to 6 months to give out those funds. Now, why would they do that?
So the scenarios that they might encounter, it's just a very rare scenario. If there is a much, much higher mortality situation. I don't, various types of scenarios where they're having to pay out large amounts of death benefit that are depleting their reserves. That's a scenario where they might encounter, you might even see it. I mean, it's not going to commonly happen, but that might be one in which they might need to delay funds a little bit.
Yeah, I would think that possibly, and that's going to be a pretty rare scenario because people don't just start dying off all of a sudden. Actuarially speaking, the law of large numbers is pretty accurate. But another scenario that might encounter that is if a lot of people suddenly request a lot of their cash value all at once. It would be similar to a run on a bank. And when you get a run on a bank is supposed to give that money right away. The insurance companies, you can't do a run on an insurance company because they do have that potential 6-month wait that they could implement. The insurance company does not just sit on cash. They sit on bonds. They own bonds. They own other assets. And so they're not going to be as liquid as what a bank is supposed to be. A bank is supposed to sit on a bunch of reserves in actual cash so that they can meet most of their daily need requirements for people coming in and demanding cash. The insurance company doesn't have that, and you might encounter a situation where maybe the interest rate environment changes, and if suddenly a whole bunch of their clients demand a loan and they've got to sell these bonds in a not favorable bond environment for those bonds, I can see them maybe wanting to hold off and wait a little bit before giving out that loan. So you do have to recognize that that is a potential risk, though I've never seen it happen.
Yeah, and I think one thing to consider there is that, yes, they keep most of those funds invested in these secure investments, but they do have a certain amount of reserves. So usually, really what we're talking about here is probably not a single one of these types of events. So it would probably be a combination of these factors that would lead to a delay, but likely not going all the way to that 6-month time frame. And in a prior episode, we did mention this Mass Mutual blog post around the situation during the Great Depression. When there was that run on the banks, Mass Mutual came in with cash to backdrop their clients in a local instance, and they brought cash for people to take policy loans. So in dire financial scenarios, life insurance has been that backstop for the rest of the financial system.
Yeah, it's been very reliable. There's no reason to assume it won't be. For the major mutual carriers that we look to use in the case of whole life, and then in the case of IUL, we like to always use large A-rated carriers, really high Comdex scores, just businesses that have plenty in reserves, no concerns that they're going to need any extra time when they're giving out these loans. But it is something good to be aware of. Now, moving away from that part of it, it's not just the credit score that we have to worry about being impacted when it comes to getting a bank loan, but also you have the actual loan showing up on your credit. So if you go to borrow anything else from anybody else, or you have other creditors or people that want to come after you, they can see that you have a loan outstanding. Not the case with a life insurance loan.
Yeah, and that's a really powerful thing, because if your financial situation is somewhat invisible to a lot of these folks, then that scenario of being like, okay, I don't need the money, you do have that access to even be able to get some of those loans that other people might not be able to get, because they're not seeing all of that activity, loan activity that you might have going on. So it can be to your advantage to borrowing against your life insurance to keep the banks from seeing that kind of stuff.
Yeah, it kind of simplifies things. If you regularly draw from your line of credit on your life insurance to go make purchases and then repay them, if you were actually going out and getting loans, each of those times, every single one of those would be on your credit. If it wasn't a line of credit, of course, but if it was separate loans that you had to go out and get, all of these would be showing up on your credit. Loans in, loans out. Loans could be potentially piling up. Those could be red flags when you need to go out and make a major purchase.
Another thing to consider when comparing your policy loans against your life insurance versus pretty much any other type of loans or line of credit is the way in which they treat that accruing interest. So it will tend to be that your interest does not compound, or it is not adding to your principal balance for which the interest is calculated until your policy anniversary. That's kind of a powerful thing too. If you want to just float a loan balance for the entire year and then at least pay off that interest, no interest will have accrued on that interest that you pay off. So, and you don't have to pay throughout the year. So it is a way in which you can sort of treat it like an annual interest only loan, or there's a lot of flexibility in how you might approach your policy loans and how you repay them. So I think that's another powerful thing to consider.
Yeah, controlling the repayment function is huge. There's no minimum payment requirement, and you get to control when you pay the interest, if at all. And the life insurance company is in a unique situation that they're able to do this. They're able to give you that line of credit that's based on the cash value in your policy without requiring any type of minimum payment and giving you a very large percentage of it as access to it without the risk of things like a margin call. And the reason they're in that unique position is because they're on the hook for hundreds of thousands or millions of dollars in death benefit on you. That death benefit will always be substantially more than whatever your loan amount is. And so far, everybody dies at some point. There isn't anybody yet that doesn't die. So they know at some point they're going to have to pay out that death benefit. And if you do still have a loan outstanding at that time, the death benefit will pay off the loan first, and then the rest will go to your beneficiaries.
Yeah, I think that's really this combination of factors is what makes having a policy loan or the ability to take policy loans against your life insurance. It's just an important thing to add to your toolkit. It doesn't mean that you're going to forego all types of bank loans, because I certainly don't. I keep bank loans on things that I think it makes sense. I just want to use the most efficient money and efficient use of money at any point. And if that means it's getting a loan from a bank or from a car company, if I'm buying, because they have introductory offers or whatever it may be, if it's a low interest rate, then I'm going to use a bank. And if I don't care about doing whatever the process is, but at the same time, if I think the most recent big purchase was a car for me. I did end up getting a car loan, but I went in there with the knowledge that if I wanted to buy cash, in the sense that I could have just taken a policy loan and had cash in my account in a couple of days, I would have that ability to do it. And having that knowledge and ability to buy a car for tens of thousands of dollars, it's a really powerful thing, and it can help you to be secure in your decisions when you're making purchases.
I think that wraps up policy loans versus bank loans for today's discussion. We have some videos on our YouTube channels. I know on my YouTube channel, I've talked about, do I use a bank loan or a policy loan when I buy a quad? That was an interesting discussion, and I walked through my thinking of why I chose one or the other. So go check that out on my YouTube channel. Have you done anything similar?
I think I might have talked about RV financing, and in the end, I paid cash, so I don't have an RV loan. So I think I did put a video out on that one.
All right. I appreciate you joining us. My name is James Barber, and I'm your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.